A great market crash is not a sudden, unforeseen cataclysm. It is not an earthquake that strikes without warning from a clear blue sky. It is the final, violent, and inevitable conclusion of a long and subtle process, a sickness that grows within the market for weeks, and sometimes for months, before the patient finally collapses. The 90%, their vision clouded by the euphoria of a great bull market, never see the symptoms. They are the cheerful passengers on a great ship, oblivious to the groaning of the hull and the rising of the water. But the master speculator, the 10%, is a trained diagnostician. He is a man who has learned to recognize the first faint, almost invisible signs of this terminal illness. Jesse Livermore was the greatest of these market diagnosticians. He possessed an almost preternatural ability to sense the end of a great boom, to see the subtle internal decay of a bull market long before the crowd was even aware that the danger was near. His legendary fortunes, particularly the great killings he made in the panics of 1907 and 1929, were not the result of a single lucky, bearish bet. They were the culmination of a patient, methodical, and brilliantly executed campaign, a 5-step playbook for profiting from the very panic that destroys the unprepared. This is that playbook. It is a deep dive into the anatomy of a market crash, a step-by-step guide to how a master speculator identifies a top, confirms the reversal, builds a great short position, and finally converts the ensuing panic into a life-changing fortune. This is not a lesson in prediction, but in observation, in patience, and in the cold, calculated courage to act on the market's own clear and developing evidence. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The entire campaign begins not with a trade, but with a diagnosis. Step 1. You must recognize the end of the mania. The first and most critical step is to understand a profound truth that Livermore learned through years of study. A market does not culminate in one grand blaze of glory. Neither does it end with a sudden reversal of form. A market can and does often cease to be a bull market long before prices generally begin to break. The top is not a single point. It is a broad, deceptive, and dangerous zone. The first and most reliable symptom of this topping process is the failure of the market leaders. The very stocks that have been the generals of the bull market army, the ones that have advanced with the greatest force and conviction, begin to show signs of fatigue. He recounted the end of the great 1916 boom. I noticed that, one after another, those stocks which had been the leaders of the market reacted several points from the top and for the first time in many months did not come back. While the secondary, lower quality stocks may be having their final, brief moment of glory, the generals have halted their advance. This is a critical warning. The second symptom is a change in the character of the tape. The volume of trading is enormous, but the prices make little or no upward progress. The market feels heavy. It churns. This is a sign that for every share the frantic, euphoric public is buying, an equal or greater number of shares is being quietly and skillfully supplied by those on the inside. The upward momentum has been arrested, not by a lack of buying, but by a massive unseen wall of selling. The third and final symptom is the psychology of the crowd. This is the moment of maximum public participation and universal optimism. The newspapers are filled with bullish stories. The last of the great bears capitulates and turns bullish. The shoeshine boy is giving you tips. It is at this very moment, when the consensus is 100% bullish, that the professional speculator knows the end is near. He understands that the public is only ever brought into the market in great numbers to provide a willing and eager pool of buyers for the insiders to sell to. Now Livermore was a master at observing the effect of these great market turns, the faltering leaders, the churning volume. But one of his great contemporaries, Richard Wyckoff, dedicated his life to codifying the cause. While Livermore was the supreme practitioner acting on the tape's message, Wyckoff was the master analyst. He systematized the science of distribution, the great hidden campaigns by smart money to unload their vast holdings at the top of the market. Wyckoff shows you the internal mechanics. Livermore shows you the external result. To truly understand the engine room behind a market crash, we invite you to subscribe to our new channel, Richard Wyckoff Trading Methods. The link is in the description below. Having recognized these clear, ominous symptoms of a market top, the amateur is paralyzed. His bullish convictions are too strong. The professional, however, knows that the time for observation is transitioning to a time for action. This brings us to the second step of the playbook. Step 2. The first test, an initial probe on the short side. Even with his conviction that the bull market was over, Livermore would not immediately commit his entire fortune to the short side. To do so would be to act on an opinion, however well-reasoned, without final confirmation from the market itself. His first move was always a small, cautious, and exploratory one. He would make an initial short sale of a former market leader that was now showing clear signs of weakness. This was his probe. Its purpose was not to make a great profit, but to test the character of the market. He was asking the tape a direct question. Is the selling pressure now greater than the buying pressure? Is the line of least resistance finally, definitively, turning downward? This initial probe was a model of risk management. It was a small, calculated bet that, if wrong, would result in an insignificant loss. He had learned through catastrophic failures that a man must not begin to advance until I am sure I shall not have to retreat. The probe was his way of ensuring that any initial retreat would be a small, tactical one, not a devastating rout. He was feeling out the enemy's lines before committing his main army to the battle. The market's reaction to this first cautious short sale would determine the course of his entire bear campaign. Having completed the first two great steps of the playbook, the master speculator now stands at a critical juncture, his mind clear and his senses sharp. He has completed his diagnosis. He has observed the telltale symptoms of a market top, the faltering of the great leaders, the churning volume, and the final euphoric rush of the public. And he has acted upon this diagnosis, not with a reckless plunge, but with a cautious, intelligent, and low-risk initial probe on the short side. The first shot of the Great Bear campaign has been fired, but the battle is far from won. The question now becomes, what comes next? How does the professional know, with absolute certainty, that his initial judgment was correct? This brings us to the third and most important step of the entire playbook, the great signal of confirmation that separates a minor reaction from a true primary trend reversal. Step 3. The failure to rally. Jesse Livermore knew that no market moves in a straight line, not even in a great collapse. After the first, significant break from the top, there will almost invariably be an attempt to rally. The bulls, who have been conditioned for months or even years to buy the dip, will rush in. The shorts, who acted too soon, will be squeezed and forced to cover. The news will turn momentarily hopeful. This rally is the ultimate test of the market's true character. The amateur, the 90%, sees this rally and is filled with relief. If he is long, he believes his faith has been rewarded. If he was considering selling, he now holds on, convinced the danger has passed. The professional, in contrast, watches this rally with the cold, detached intensity of a hawk. He is not interested in its existence, but in its character. Is the rally strong, vigorous, and on high volume, with the old leaders once again taking charge? Or is it weak, anemic, and labored, occurring on light, unconvincing volume? Most critically, he asks one question. Does the rally have the power to push prices to a new decisive high above the previous peak? If it does, then the bull market, while wounded, is not yet dead. But if it fails, if it peters out below the old highs, it is the single most definitive and powerful confirmation that the great bull has finally been slain. This failure to rally is the market's own unambiguous announcement that the great buying power that once propelled the advance is now exhausted. The sellers are now in control at a lower price level than before. The line of least resistance has irrevocably shifted from upward to downward. Livermore did not need to know the reasons for this weakness. The fact of it, as registered on the tape, was all the information he required. It was the final deciding vote. His initial bearish probe, which began as a high probability supposition, was now a confirmed factual reality. The time for caution was over. The time for aggressive, decisive action had arrived. This leads directly to the fourth and most aggressive step of the playbook. Step 4, building the line, pyramiding down. With the bear market now confirmed, the professional speculator's job is to press his advantage for all it is worth. The amateur, who is still hoping for a return to the old highs, is now on the wrong side of the primary trend, a fatal and costly position. The professional, having received his confirmation, now has the market's own permission to build a great and powerful short line. He is no longer probing, he is attacking. Livermore's method for this was the perfect symmetrical inverse of his bull market strategy. He would add to his short position on a declining scale, a practice of averaging down a winning short trade. His rule was absolute. Never make an additional sale unless it is at a lower price than the previous sale. He was not simply selling into a panic. He was methodically adding to his line at each new logical stage of the decline, typically as the stock broke through a new lower pivotal point. He was reinforcing his success. His initial probe was profitable. His second edition, at a lower price, was a bet on that success continuing. If that too was profitable, his third edition was made with even greater confidence. He was building his great short position on a rising scale of confirmed, market-proven success. His largest commitments were made only when the downward trend was powerfully and demonstrably underway. His great campaigns in the panics of 1907 and 1929 were the ultimate expressions of this principle. He did not simply sell a fixed amount at the top and wait. He began his 1907 campaign with his initial sales, but as the market broke, as the money situation grew tighter, as the rallies became weaker and weaker, he grew more and more aggressive. He was pushing his luck for all it was worth. Not as a gambler, but as a professional who had been given an irrefutable signal and was now capitalizing on it with the full force of his capital and his conviction. This is the great secret to profiting from a crash. The fortune is not made from the initial brilliant diagnosis of the top. It is made in the subsequent disciplined and aggressive building of the great short line during the main body of the decline. It is this pyramiding of a correct bearish position that transforms a good trade into a life-changing one. It requires not just analytical skill, but the cold, calculated courage to become more and more aggressive as the market becomes weaker and weaker, to sell into the very declines that are causing the hopeful 90% to freeze in terror. The master speculator, having completed the first 4 great steps of his playbook, now finds himself in a position of immense and terrible power. He has correctly diagnosed the end of the great bull market. He has tested the market's weakness with a cautious probe. He has received the definitive confirmation of a failed rally. And he has, with cold and calculated aggression, built a great and powerful short line as the market has declined. He is in perfect harmony with the primary bear trend. But the campaign is not yet over. The final, and in many ways most dangerous and most profitable act of the drama is about to begin. The panic. The market, which had been declining in a more or less orderly fashion, now begins to accelerate its descent. The public, the 90% who held on with a desperate, all-consuming hope, who bought every small rally believing the turn was near, who listened to the reassuring lies of unnamed insiders, are now confronted with the brutal, unforgiving reality of their mistake. Their margins are exhausted. Their brokers are calling. Hope, their treacherous friend, finally abandons them, and in its place comes a new and far more powerful emotion, sheer, abject terror. This is the psychology of a market crash. It is the moment when the last of the great mass of holders is forced to liquidate, not because they want to, but because they have to. They are no longer selling based on analysis or opinion. They are selling out of a primal, instinctual need to escape the pain. It is this forced, panicked selling that creates the final climactic and vertical stage of a bear market, the great selling climax. This brings us to the fifth and final step of the playbook, a step that requires the ultimate in professional detachment and counterintuitive thinking. Step 5. You must recognize the climax and begin to cover. To the amateur, a market in a state of freefall, a market where prices are collapsing by the minute, seems like the most obvious and most profitable time to be short. His instinct is to sell more, to join in the slaughter. The professional, however, sees something entirely different. He recognizes the panic not as an opportunity to become more aggressive, but as his one great heaven-sent opportunity to exit. Livermore knew this with an absolute certainty. A panic, a selling climax on enormous, unprecedented volume, was not a signal to press his bets. It was the great final bell, the signal that the bear move had run its course and that the time to turn his colossal paper profits into real, tangible cash had arrived. He understood that the very panic that was destroying the last of the bulls was creating the perfect market condition for the professional bear to liquidate his line. This leads to the great final secret of the playbook, the professional exit. Livermore's rule was absolute. You must cover your shorts in a demoralized, weak, or panicky market. He wrote with the wisdom of a man who had managed great campaigns. You cannot always sell out when you wish or when you think it wise. You have to get out when you can, when you have a market that will absorb your entire line. A panic, with its millions of shares being thrown overboard in a state of terror, provides the one thing a great operator with a massive short line needs: a practically unlimited bid for his stock. He is not trying to cover at the absolute bottom price. That is a fool's game. He is concerned with one thing, and one thing only: the ability to buy back his tens or hundreds of thousands of shares without his own buying creating a violent rally against him. In a normal, orderly market, the act of buying back a 100,000 share short position would be enough to cause the price to skyrocket. But in the midst of a panic, his buying is a single drop of water in a raging waterfall of public selling. He can absorb the panicked liquidation, covering his entire line with an ease that is impossible under any other condition. His actions during the Great Panic of 1907 were a testament to this principle. As the market entered its final convulsive stage, as hell broke loose on the floor of the exchange, as there was no money anywhere and you can't liquidate stocks because there is nobody to buy them, he was not selling more. He was buying. He had recognized the climax and he was taking his great profits. He was not just a bear who had been right, he was a professional speculator executing the final logical step of his perfectly laid campaign. This, then, is the complete 5-step playbook for profiting from panic. It is a journey that moves from quiet, patient observation to a final, decisive action in the heart of the storm. Step 1. You observe the end of the mania, the faltering of the leaders. Step 2. You test the market's weakness with a small initial probe. Step 3. You wait for the definitive confirmation of a failed rally. Step 4. You act with controlled aggression, building your great short line as the market declines. And Step 5. You execute your professional exit, covering your entire line into the very climax of the public's panic. This is not a lucky guess. It is a logical, repeatable, and profoundly effective campaign. It is a strategy that is in perfect harmony with the market's own timeless psychological cycles. It is the understanding that a crash is not an event to be feared, but a process to be understood, anticipated, and, for the man who has done his work, to be profited from. It is the ultimate expression of speculation as a serious intellectual business. To truly understand the mind of the man who navigated these great financial storms, it is not enough to simply know the rules. You must feel the pressure, the doubt, the fear, and the quiet, profound confidence that defined his greatest moments. For this, there is no greater chronicle than Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator, This is not a dry textbook of market theories. It is the ultimate case study in market psychology, a flight simulator for the trader's mind. Lefebvre's genius was not just in telling Jesse Livermore's story, it was in capturing his internal monologue during the greatest financial storms in history, the panics of 1907 and 1929. The book allows you to sit beside him, to feel his internal battles, to understand the deep human reasons behind his rules. For those committed to this deep study, we highly recommend the edition, which includes a unique, detailed chapter-by-chapter analysis by Max Davidson. This analysis acts as your co-pilot, translating the century-old wisdom of the text into a clear, actionable roadmap for the modern trader, ensuring that the lessons learned in 1923 are as powerful and as profitable today as they were then. A link to this essential edition is provided in the description below.